Alrighty. So in today's video, I'm going to be talking about how proprietary traders trade for a living. Now, if you don't already know by now, I have been a proprietary trader when I was in my younger and more glorious years. That was about 13 years ago, right? I was a proprietary trader for about 5 years, right? Back then when I had, much better eyesight and definitely much better hair as well. So I had a number of people reach out to me, because they read the description on my YouTube channel that I was a proprietary trader before, and they were interested to find out, how proprietary traders trade, right? What they trade, what's their trading style, and how they get paid as well. So, I thought that I might as well just create a video to share, my time back then and my experience as a proprietary trader, so you can take this insight, and apply to your own trading as well, because there are a few things that you can take away from there. There are a few things that you do want to implement that what proprietary traders do that can help you trade your own retail account, your own money in options much better as well. So first of all, I want to give you a trivia. When I went to Google and typed the search term proprietary trading firms, there were a number of images that came up, and two of the images that showed up was this. And I found this very interesting because one of the pictures here is actually a prop trading firm, whereas the other one is not a prop trading firm. So can you guess which one is the prop trading firm? So if you have guessed that this is the prop trading firm, then you are correct, right? So this is the prop trading firm, and this is most likely not the prop trading firm. And I'm pretty sure this is definitely not a prop trading firm. And there are a few things that give away, right? So first of all, for the prop trading firm, how you know this is a prop trading firm, there are a few things that you can notice from this picture is that basically you notice that the guys down here are dressed very casually, right? This guy's wearing t-shirt, this guy's wearing hoodie, and this guy's wearing sandals, right? Sandals and slippers. So back then when I was in a prop trading firm, we were wearing, very casual clothing. We were very slack. Basically, there was no dress code. You can wear pretty much whatever you want because we are not facing clients. We're not going to see any clients. All we do is that we're staying in this room pretty much all day long from market open to market close, and the only people that we see is each other's faces, right? So there's no need for us to dress very nicely or to impress anyone. And the next thing that is also a giveaway is this screen down here, right? So in trading firms, we do have many screens, but not all the screens are for trading, right? At least the prop firms that I know of, right? So basically we have one screen that we can use to do whatever we want, right? We use this to surf the internet, read news. There's nothing to do with trading. We even watch movies back then, right? So as you can see, it's pretty relaxed. But whereas for this picture down here, you can see the people are much more tense, right? And the biggest giveaway that this is not a prop firm is this phone down here, right? Because as a prop trader, we generally don't need to call anyone. There's no need for us to phone anybody because we are all pretty much side by side, right? The only people we need to talk to is each other. Occasionally, the boss, right, the big boss guy, would come out of his room and then speak to you. And if he does do that, you're in for some trouble, right? That's most of the time he'd be coming out to shout at you if that's the case, right? But there's no need for us to have the phone. So this picture down here, you can see that they're wearing very smart. They're wearing shirts, and this guy even have his headphone down here. Most likely to speak to their clients, right? So these are most likely what you call sales traders. So they are traders in the sense where they execute the trades, but they are not the one that actually makes the decision to buy or sell. Rather, they are just there to recommend trades, right? Maybe the institutions have told them to recommend or push certain stocks to their clients, so that's what they're doing, right? So they will have to call the clients, whether it be it retail investors or institutions. So that's why there's the need for them to speak on the phone. So the way they make money is not through trading the markets, but rather through the commissions, where each trade or each time when they get their clients to buy something, right? There's a commission and they get a commission share. At the same time, they get salary or some commission sharing as well, right? So the proprietary trader is very different, right? There's no commission that's being paid to them because they are trading the markets for profits, right? The only way they make money is if they are profitable in the markets. Whereas for this group of people here, how good they are, whether they make money, depends on their sales volume. Now, what is a proprietary trader? So if you are not familiar with the term proprietary trader, so basically proprietary traders are professional traders who trade for a living and they work for a proprietary trading firm, right? So basically proprietary trading firms, also known as prop firms, they are institutions right? But they are not as big as banks, but they are institutions where they have their own money. This money could be gotten from, you know, investors, or it could be the founders' own money, right? So it could be either of them. And then they will hire traders to trade their accounts. So they will have many different accounts for each of these traders to trade, right? So what are the products that prop traders trade? So the products that the prop traders trade comes down also to what kind of prop firm it is. And there are a few different kinds. There is the equity prop firm, where they mainly trade equities. Then you have the futures prop firm as well, where they mainly trade futures. There are many different types of futures: currency, bonds, commodities, interest rates, the index as well. And then you have also the forex prop trading companies. And also recently, there are crypto, right? Back then in my time, there is no crypto prop firm. I've not heard of them. So I had been on the equities and the futures desk before. So my experience is in these two areas. So how do prop traders get paid, right? So their remuneration. So there are basically two types of payout schedule that I know of. So number one is with a small salary plus profit sharing, right? Or just purely profit sharing. That means you do not get any salary whatsoever. So if you're going for a small salary plus profit sharing, usually your profit sharing is pretty small, right? It's definitely less than 50%. And then you have at least a fixed salary every month, but this fixed salary is not a lot. And then you have profit sharing as well. If you take purely profit sharing, then you will have a bigger share. So sometimes it could come in tier levels. So for example, if you're made a certain amount, you get a certain amount of profit sharing. And it also very much differs from firm to firm, right? Certain firms will pay their traders more, they will have a bigger profit share. But usually the profit share at most, if I'm not wrong, should be 50%, right? That was the one that I was getting when I was at the prop firm. Now, if you are at a good proper prop firm, they will never ask you to put in your own money, right? So I've heard of some prop firms where, you know, they will interview you and they say that if you did well, they will let you trade their account, but you have to put up some of your own money as well. So they say that the risk is equal, right? Now, normally good prop firms do not do that. If a prop firm is asking you for money, that's a red flag. You might want to do more research first, because most of the time they will only risk their own money. So in a sense, there should be no risk to you. Okay, so what strategies do proprietary traders trade? So in my stint there, I can tell you that the proprietary traders actually trade high probability trades, right? That means you actually make consistent small profits and then the occasional big losses. And these trades are not like what you would read in those books like trend trading, or learn all those chart patterns and all that stuff. Those are more directional trading, right? Proprietary traders, or at least the experience that I have with my proprietary trading firms that I've been working for, they don't really go for directional trading, because directional trading is actually very tough. There's no real edge there other than the fact that you have to be a good trader, right? Whereas for proprietary trading firms, they generally find an edge in terms of the mechanics and the strategies itself. So there are basically two types of strategies, at least at the prop firms which I was at, they were employing. So number one is spreading. So it's pretty similar with options, whereby, you know, you have spreads, right? You would sell one option and you will buy one option, right? So for this, what they would do is they'll be spreading. So this is for the futures desk. Basically, they'll be spreading two very high correlated instruments, right? So you can see this screen down here. You can see this is what you call a ladder, right? This is a ladder. This is called TT. The platform is called TT. So basically, they will be putting the orders down here. So what spreading involves is two highly correlated instruments where they tend to move together most of the time. And then what they do is that they find deviations. So there'll be certain times where one of the instrument will move away from each other, right? So for example, if this is instrument A, instrument B, so let's say, for example, most of the time they will move together like this. So they will move in tandem. Then all of a sudden, maybe at one time, this will start to move up. Then this would maybe stay still or start to move down. So this is where there is a little bit of a discrepancy. So this discrepancy is where they will start to enter into the trades, right? This is called spreading. So what they will do is they will sell this one and then they will buy this one. So what they are basically trying to do is to mean revert the spread, because eventually the spread in the long term should revert back, and then they start to move in tandem again. So they're trying to find these small little edges to make money, right? So this is what basically they'll be doing in and out. So This is a high probability trading style because a lot of times, right, this movements, this small discrepancy when they start to tend to move away from each other and then they trade on both sides, it will converge back. So once it converge back, that's where they make the money, they get out of the trade. But there'll be times where the divergence, right, will be very big, right? This is what you call the spread will start to tear. So that means the market for A, all right, may go all the way up, and then for B will start to continue going down. So the spread will get wider and wider, and then they will start to lose even more money. So this is where you have the occasional big losses. That's when the spreads start to tear. But for most part, for the most of the time, it is a very high probability trading strategy. And if you think about it, it's very similar to selling premium when we're trading options, because again, it's the same thing when we're selling premiums, right? When you're trading out of the money options, you are basically getting small profits relative to the losses that you could make, right? These are occasional big losses. So the mindset that some people have is that, you know, this is so dangerous because you are like picking nickels, or what you call that, picking coins, nickels in front of a railway track, right? You have small wins, but then when the train comes, you're going to get wiped out. Now, this is true if you do not know how to manage your money well, right? If you do not know how to manage your risk properly, that's how you can get wiped out. But at the end of the day, if you were to manage your trades well, this is actually very profitable, right? This is profitable. Otherwise, why would prop firms still be around, right? Because their strategies work, right? It's very small wins and then the occasional big loss. At the end of the day, as long as it's a positive expectancy, you will still make money. The other way, which they did, will be day trading and scalping. Basically, scalp the bid and ask spread. Again, it is a very, very high probability trade, and then you will have the occasional big losses. So if you are interested to know how they actually trade, I can just give you an insight. Right, so let me try and remember as much as I can. Remember, this is 13 years ago. All right, so basically what they will do is they will scalp the bid and ask spread. I'm pretty sure you've heard that before. So this is pretty much a little bit like a market maker trading style, right? All you're doing is just make that 1 cent each time, and you'll be surprised. You know, you might be thinking, you know, 1 cent, what can you make with just 1 cent? But actually you can make quite a bit, right? Because the orders are pretty big. It can be 10,000, 100,000, right? So 100,000 of 1 cent can be pretty good. So that is a pretty good, decent amount of money. And this happens in a matter of seconds or even minutes, right? So they'll be in and out throughout the whole day. Okay, so how do they actually trade? I'll just give you a rough idea. Okay, so basically you can see this is the bid and ask spread of a stock. So basically they would find those cheap stocks, generally under $1, penny stocks or something like that, with very, very high volume, right? So you can see that there's quite a bit of volume. Some of them can go up to 1 million shares. So each number down here, basically this means there's 85,000 shares down here on Q. So then you have your own orders, right? So these are all your orders on the bid. That means you are buying the shares at this price, and then these are all your orders on the offer, right, or the ask, where you are selling the shares, right? So basically, these are limit orders. These are market orders. These are limit orders, and you can see you're on both sides of the market at the time. So the whole idea down here is that you want to just beat the queue system. So if you're not familiar with how the order entry actually works, so you can see down here there is 99,284 shares, right? So if you were to put in 10 shares down here, let's say you are the last person to make up this 99,284 shares, it means you're right at the bottom. So that means there are 89,000 plus shares on top of you, right? So let's say, for example, the first person may have 20,000 shares, the next person have 10,000 shares, and so on and so forth until it's your turn. You're at the bottom of the food chain, right? You have 10,000 shares. So what will happen is that whenever there is any order as is taken out, that means if there are some people that actually hit the bid, right? That means there are traders that want to sell their stocks, they will hit the bid, they will sell at $1. So once they hit this bid, they sell it, it will come to the first person here. So let's say the person who wants to sell their shares, they want to sell 10,000 shares, right? So they will sell 10,000 and they will hit the bid at $1. So they are out at $1 for 10,000 shares. And then for this first person, he wants to buy 20,000 shares at $1. So what will happen is that he will have 10,000 shares filled, he will have 10,000 shares. All right. So you do not get any shares because you are at the bottom of the food chain, right? You are still queuing for your chance to get hit or to get filled. at $1. Right, so as the days goes by, right, there will be more people queuing behind you, right? You'll be queuing, more people queuing. So slowly you will make your way up until you're first in line in the queue, right? So when it's finally your turn in the queue, right, maybe at this time on the right hand side, you are also the first person in the queue as well. So what will happen is that you will immediately buy and then immediately get taken out, sell very quickly. So you make that 1 cent, you're out of the market, right? So this is how pretty much they trade. So what they are really doing is that they're just trying to find themselves at the front of the queue. So you can see down here that there are 104,000. You want to know which is your position in the queue. Now, of course, just by looking at this, you're unable to see. So, okay, this is what you call the different levels, right? The inside bid and ask, this down here is called level 1, right? Level 1. You are able to see the volume just for the inside bid and offer. This is level 1. Level 2 is this whole thing down here. That means you are able to see the volume and a bid and ask spread for all the other levels. So this is called level 2 quotes. And then there's actually one more level, which is called level 3 quotes. So level 3 quotes are basically this. You are able to see the queue order, the pecking order, to see where you are in the queue. Right? So if you are all the way at the bottom, then you know that you are not going to get filled very quickly at all. But if you're the first in queue and there are many people lining up behind you, then guess what? You have a very good chance to get filled and then also get filled on your order on the ask side as well to make this 1 cent scalp, right? Now, here is where the risk is, right? You have to manage this very well. The risk is that there is a lot of manipulation. The manipulation, right? So let me just remove some of these drawings to make it very clear first. So here's the manipulation, right? You might be, let's say, the last person down here. Okay, let's just say you are this last person down here, 10,000. So what will happen is that if all of a sudden, somebody down here, they decide not to get their shares filled, they could pull all their shares away, and all of a sudden, instead of being a buyer, there's one guy who decides to sell all the way down. So they will hit 100,000 shares on the bid, and all of a sudden you will get filled on all this. So this is how price moves, right? The price moves when there's no longer any buyer on the bid. So all of a sudden 100,000 will sweep all these orders, and all of a sudden now it will become offer. So what happens now? 96 cents will now be on the offer, and the inside bid will now be 95 cents. So this is where you are in trouble, because you got all these orders got filled at $1, at 99 cents, 98, 97, 96, and then now the current price is 95 cents and 96 cents offer. So you are caught in a position and you're losing money, and the ship is sinking really fast, because if there's more people that see this selling and all of a sudden they also pull their bids, that means there is suddenly nobody wanting to support the level down here, and there are more people starting to sell it because they're afraid the market is going to go further down. Then guess what? You'll be pushed even further. And here's the thing with proprietary traders, right? They don't really place any stop loss. In fact, there's no hard physical stop loss. They use mental stop loss. So when you have a mental stop loss, it all comes down to your own discipline, whether you can get out of the trade or not. If you can't get out of the trade in time, then you're going to lose a lot of money, and that's where you're going to get into trouble. Alright, so this is basically how proprietary traders trade. So the takeaway is that it's actually high probability trades, that you get consistent small profits and then the occasional big losses, and what you really need to manage is big losses. And this brings me to my next point. By the way, if this video has been helpful so far, I'd appreciate if you hit the thumbs up button and also subscribe to my channel so I can create more videos like this for you in the future. Okay, back to the video, which is the props firm's primary focus, and that is on risk management, right? Risk management is very important. So managing risk is the key focus of prop firms, because they want to ensure that no one single trader will wipe them out. You see all these traders down here, one of them will be inevitably the joker, right? Not necessarily this person, but this person is going to lose you a lot of money because he's not going to be disciplined, and he's going to cause a lot of loss for the firm. So what the firms actually employ is actually a maximum loss for the day, right? For each trader, depending on their size and their trading ability, right? So newer traders generally have a much smaller risk tolerance or risk limit. That means, let's say if they lose a certain amount for the day, the prop firm will tell them to stop their trading for the day, right? They cannot trade, so they would have to close out all their position. If you are a senior trader or you're more profitable, you have a bigger size, then you have a bigger risk limit, right? So interestingly enough and ironically, most prop traders aren't good at managing their own risk, right? You see, most of the traders down there, they really want to make money, and it's also, the reason is because they are not trading their own money. You see, when you're not trading your own money, you can't really be too concerned about your downside, because for the prop traders, there really isn't any downside in terms of monetary, because they don't fork out their own cash, their own money. The prop firms, on the other hand, have all the risk, right? They do not want just one of these jokers, right, to lose everything for them, right? Then they are suddenly out of business. So that's why risk management is very important. So I want to share with you two stories that happened back then when I was at the prop firm. So one of them actually happened on the very first day when I joined the prop firm, right? I was very excited, very young. I went into the prop firm, and then they set me beside this senior trader to just learn the ins and outs of how they trade, right? So they have many screens and all that. So there was this senior trader on the opposite side of the desk. So I was sitting behind, so you see this trader down here, there's a screen behind here, I'm sitting behind here, and then just directly opposite of me, there's this senior trader down here, right? So this senior trader down here happened to be in a stock that was caught, right? The stock suddenly had a lot of selling going on, and then it pushed all, it went all the way down, right? So this trader got a lot of his bids, orders got caught. So remember this picture I showed you down here? So he had many orders down here all the way down. So most likely that he got caught because there was a sudden sell order that got him filled on all of this, and he didn't have enough time to pull out all these orders by himself manually. He didn't have enough time. So what happened is he's stuck with a huge loss, right? It is a very big loss. And at that point of time, he was still holding on to the position. Now, we didn't know what exactly was happening until the big boss man, right? There was the boss, a pretty big guy, sized guy. And then he came over here and stand directly behind this guy down here. So he's a very big, towering man, right? He came out from his room, which he never usually does, and if he comes out, you know something is wrong. So he stand behind this trader and then just watched him and just waited for him to see whether he would notice him or say anything. But this trader down here, I'm not sure whether he knew that the big boss man was standing behind him, but he basically just ignored the boss. He just stared at his screen, right? Almost like a deer in the headlights. He's not sure what to do. So the boss then finally said to him in a really loud voice, asked him, when are you going to get out of the trade? Right? So this trader down here just said, oh, I will get out soon. I'll get out of this offer. I'll place all my orders when I'm caught. So if you're caught on all these orders, in order for you to get out, is either you hit the market, right? That means you hit the bid to sell out at whatever available price there is, or you queue on the ask. Hopefully somebody will buy up one tick and clear you out. So what he did is that he decided to queue on the offer instead of actually hitting bid, right? Hitting market. So he queued down here. Hopefully the market might trade up a bit and slowly clear out his orders, his positions, so that he will have a smaller loss. So he told the boss that he's going to do that. So the boss said, okay, make sure you do that. So the boss went back to his room, and then 5 minutes later, the boss came back out again, and this time he started to hurl vulgarities at him and asked him to just get out of his position. He said that, why are you not getting out of your position? A lot of vulgarities, cannot really remember very clearly, but I remember I was pretty scared down here. I was down here behind the screen and just wondering, oh my goodness, what is happening, right? So this is a senior trader that has been around for many years, right? Later, I learned from the other traders that this guy has actually been around for a very long time. He was actually also pretty decently profitable, not the most profitable trader around, but he's decently profitable. But he has made this big mistake. So the boss got really angry, and the boss just said this, get out, right? Asked him to get the F out, asked him to pack up his stuff and get out. So the boss pulled him out of his chair, and the boss sat in his chair and manually exited his position. Right, that's it for you if the boss have to exit your position, right? That's your life as a trader. There is no more. You're gone. You're out of there immediately. So he had to pack up his bags and just leave that day on the spot, right, in front of all of us. So this was quite a big shock to me, because this guy has been around for quite some time. He's a senior trader, and he probably has made the firm quite a bit of money. But because of this one mistake he made, he got asked to leave asked to get out. So what the morals of the story is that the prop firms is very firm on their risk, right? They really want to manage their risk well. They don't really care whether you have been doing good or not. But if you break one of this rule, this is one of those cardinal sins that you cannot make. And if you break it, that's it. You're out for you. So I remember also another time, right? So this is another story I want to share with you. I remember another time where I myself had been caught in a similar position like this trader down here, right? All of a sudden the stock just sold off, and then I got a lot of my positions caught at one time, right? And I was about to hit my loss limit, right, for the day. In fact, if I'm not wrong, I think I pretty much exceeded the loss limit for that day. And what I did is that I decided to just get out at market, right? Just hit the bid, get out everything, and then I got out all my other orders as well. So I'm flat for the day. I have no positions. So what I did immediately was I got out of my seat and I went to the big boss man's his room. I went over there and then I told him that I got caught out on the stock and then I hit my loss limit. So I removed all my orders, all my positions. So I was actually expecting a scolding because I remember this guy very vividly that he got scolded. So I was just waiting for a scolding basically. But the boss didn't actually scold me. He asked me one question. He asked me, was there anything that you could have done better? So I was actually surprised by this question because I thought I was going to get scolded. But instead, this question made me think, and I told him this. I told him that yes, I could have actually gotten out earlier, but I didn't want to, right? I could have immediately hit the bid when I saw that something was wrong, hit the bid, get out, take my loss. Instead, I decided to queue on the offer as well because I want to slowly get out of my positions. Hopefully that I would lose lesser for the day. So I told him that I actually could have gotten out earlier, but I didn't because I was hoping to lessen my loss. Hopefully the stock will trade up. So then the boss actually said to me, I'm glad you told me that, because he was actually sitting at his desk and already looking at my screen, because at his desk he have a lot of monitors as well, right? The boss have many monitors, so the monitors are all about risk, right? He can see which trader is losing how much. He knows all the P&L of every single trader. So he's sitting there staring at all these screens all day long. So he said that he was actually looking at my account and he was waiting for me to come in. He was waiting to see what I would do. So he said that he was glad that I actually came in and told him about this. I initiated this, that I actually took a loss rather than wait for him to come out and tell me. So because of that, he told me, said that I actually did well for it, right? I cut off because he mentioned that many other traders, right? There are many other traders down here. You can see on the screen down here. They were actually in a loss and they were still in a position. I was the only one that came in and then told the boss that I had a loss. So the boss said that he's also still waiting for these other few guys to see what they do. Are they going to just come out, or does the boss have to go out to go and talk to them? So the boss told me, said that luckily you said that, because if you were to say something else, like give an excuse, then he would have scolded me, right? Because he said the previous other trader came in, made an excuse that he couldn't get out earlier, right? Remember, if you are in a trade, you can always get out earlier. There's no such thing as I can't get out earlier, right? The excuse that the other trader made was that because he said that he had queued on the offer down here and he said that he was just not taken out, so that's why he couldn't get out. But that is not true, because you could just hit the bid immediately, right? If you hit the bid, you are flat. You're out of the position, you take your loss. So the reason he said he cannot is because he didn't want to. He didn't want to take the loss, such a big of a loss. He wanted to minimize his loss. But because of that, the market went even lower. He took even a bigger loss. Right? So that's the story I had for you when it comes to risk. So the boss even actually just told me, now that you have gotten out of the trade, you actually did well enough to know where you're supposed to get out. Now just relax, right? Go and watch a movie, right? So the boss actually told me to go and watch a movie on the screen. Remember the first picture which I showed you down here, this guy with a screen? Yeah, he told me to just go and watch a movie. So that's what I did. So the rest of the time I just went there and I watched a movie. He told me don't trade for the day, come back tomorrow, refresh, start all over again. Meanwhile, there was another trader that at the end of the day, apparently on his screen showed a lot of profits. But the boss was very curious because the boss actually went over to his screen. There was another guy that was sitting down here, right on the other end, facing this monitor. So the boss again went behind this guy who is standing down here and then just looked at his screen, and the boss was very puzzled. And the boss was very puzzled and was wondering what's going on, because on his screen he saw that there was a huge loss, there was major losses. But then on this guy's screen it shows that it was all profit. Then later on he found out that what this trader did is he hit the stock, right? He somehow hit the window of the stock, or he removed, I'm not sure what he did, but somehow that the P&L was not showing up. And this boss found out, he was so furious, and he fired that trader again on the spot. Right, so as you can see, again, the moral of the story is do not play with risk. Now, as a retail trader, right, likely you're retail trading your own money, you want to really manage your risk very well. Because if you don't, then guess what? You don't have a boss, a big boss man to come out and tell you, say, hey, you better cut your risk right now. No such thing, right? With your own money, if you lose all your money, that's it. That's all your hard-earned money. All right, next, how much do prop traders make? So basically there is a wide range in terms of how much prop traders make. They can be very profitable, like 5 figures a month. I haven't seen a trader that's 6 figures a month, also mainly because of the size where the prop firms want to regulate, right? They do not want one single trader to have too huge of a size. Otherwise, you know, if the guy just goes broke, he's going to lose a lot of money. So the most I've seen is 5 figures. I personally, back then, right, I was doing about $40,000-$50,000 a month trading. But of course, it does not all go to me, right? There's profit sharing. And the way the boss did it for me is that the pay which I would get, or rather my profit share, would be split over 10 months. So I do not get it all at once, right? So on the other hand, the prop firms actually make quite a bit of money. So you can see that, right? And then on the other hand, you have traders that are not profitable, right? They still owe the firm many months of desk fees. So I remember I spoke to one trader that was relatively new and asked him how he was doing, and he told me that it's not very well. It's been about a year that he has been at the firm, but he has not really been that profitable because he was not that consistent. Certain months he was profitable, certain months he's not, but he owed many months of desk fee that for 1 year he was actually not making money at all. In fact, he was bringing his lunch box to the firm. So I was wondering, you know, every time we would ask him to come and join us for lunch, but he wouldn't want to eat lunch with us. Until later on I found out the reason why he brought his lunch box was because he wasn't making money. He couldn't afford that, right? So he has to get his food from home. Maybe he made it himself, or his parents made it for him, and then he would just pack it to the trading firm, and then he would just eat it there so he wouldn't spend money, right? Sounds a little bit sad, but that's pretty much how it is. All right, so finally, how does this relate to you in terms of trading options? So you're trading your own account right now. What can we take away from, you know, what I've just shared with you today? And there are a few takeaways I feel is pretty important that definitely will help you in your own trading right now. And the first of all to understand is that professional traders trade high probability trading strategies where they take consistent small wins and the occasional big loss, but overall profitable, right? So the beauty about trading options, right, is that you can design your own risk and reward, right? You can design your own probability of profit. You can either go for directional trades, right? That means you go for maybe like debit trades whereby there is a roughly 50% chance of profit, or even less if you're going for out of the money kind of debit spreads, like out of the money call spreads. Those are low probability trades, right? You may have one or two just for speculation, but you do not want it to be the big bulk of your own trading account, because it's going to be very hard for you to be right, especially when it comes to options, okay? So you want to go for trading strategies that is more than 50%, right? So simple strategies like credit spreads, right? Short put, and also like iron condor. These kind of strategies are all high probability trading strategies. So you too should choose high probability strategies to generate a consistent income. That's because trading a low probability strategy, right, can affect your psychology when you suffer a losing streak. So you will start doubting the strategy and also fear taking the next trade. So I actually shared this in previous videos of mine whereby I showed you this table of losing streak, right? So if you have a 50% win rate kind of strategy, which is the best that most debit spreads can give you, right, then there is a pretty large losing streak that you could face, right? You could lose like 4 to 5 times in a row. Is very possible. So when that happens, it actually messes with your psychology. You're going to be a little bit afraid of taking the next trade, and that can actually affect your trading strategy, your expectancy, because you could be profitable in your next trade, but because you got so many losses in a row, you're afraid of taking the next trade, and then you miss that one out, right? So instead of going for that, you might want to go for higher probability strategies, because if at the end of the day they're both going to be profitable, then you might as well take the easier route, right? Because this way you actually generate, more consistent return and have a shorter, smaller losing streak, right? For example, if your strategy is a 70% win rate, then the chances of you having a losing streak of 4 or 5 in a row is very, very, very low. Next, it's not necessary to trade many underlyings, right? Professional traders focus on a handful of underlyings and thoroughly understand the characteristics of what they trade, right? So professional traders, they trade a handful, right? Maybe 5 to 10 stocks. Even in the futures, you need to trade 1 or 2 or 3 products, right? And for myself personally, for trading options, I actually only trade mainly the index ETFs. That's the main bulk of my trades. They are my staple trades, which I call them. And then I do have some supplemental trades here and there on stocks, right, occasionally, but I only really have a handful of stocks which I trade, right, mainly the index ETF. So there is really no need for you to actually trade so many different products if you don't need to. There are many other ways to diversify other than just trading different stocks or different products. Now, the biggest takeaway from this is the risk management part. You see, risk management is very important if you want to stay in this game long enough to be profitable. So you are trading your own hard-earned capital, so you must manage your risk well. And more specifically, you want to manage your size per trade to make room for the outlier risk. So you want to allocate no more than 5 to 7% on any single trade. So remember, with high probability trading strategies, you don't want to say you want to avoid those big losses, because they are all part and parcel. Again, you cannot avoid these big losses. They will come, but you just need to make sure that when they do come, you have sized them appropriately so that they do not actually take a big bulk of the trade, right? So it's like just driving car. If you want to drive a car, you cannot say I want to avoid an accident or avoid traffic jams. There's no way for you to avoid that, right? You want to embrace it and expect for it, and then just plan it out well. So in terms of option trading, the good thing is that the outlier risk is actually not that frequent, right? The chances of an outlier risk where you really hit the tail end risk is very small, but they do happen. Like for example, during the 2020 pandemic crash, when they happen, you want to make sure that your size is not so big that it wipes out your whole account. Okay, so that's where you hear many stories where people trade those undefined risks, like maybe just short puts or strangles, and then they got their trading account wiped out. Now, it's not the strategy that is sort of risky, but rather it's your risk management, right? If you're going to risk like 20% of your account, then you have no one to blame if one single trade wipe out your whole account. So understand that you can't win every single trade, and you will suffer the occasional outlier losses. So you must keep each trade size small enough and manageable so one loss will never wipe you out. So you can also smooth out your P&L by spreading out your trades. So this is another way to diversify. You don't have to diversify in terms of different stocks, different products, because most of the time when the market crashes, right, such as the pandemic, suddenly everything is very correlated. They all move down at the same time. So guess what? If you were to place all your trades roughly around the same time before the pandemic, when the pandemic comes, all your positions will be hit. So rather than doing that, there's another way, is that you can diversify by time, right? So that means you can space them out. That means different days, different weeks, different months, you have different trades on. You can diversify by price, different price levels. You can diversify by the option expiration date, right? The days to expiration. Different strategies. You have neutral strategies, bullish strategies, bearish strategies, and then also by delta, right? You can have small deltas, high deltas. So by spreading all this out, you have a much more smoother P&L rather than, you take the same trade on the same day across different products. Next, understand that to achieve the true probability, you need to clock enough trades. So again, I mentioned this in a previous video. So the best example, or the simplest example I can give you, is just flipping a coin, right? It's a 50-50 chance to get heads or tails. But if you were to flip it 10 times, there's a chance for it to get 7 heads and 3 tails. So imagine heads are when you lose. So if you get 7 losses, does it mean that this strategy is not working out? Doesn't mean that way, because if you were to flip the coin 1,000 times, then chances are you're going to get very close to 50% of the time you're going to get hits, 50% of the time you're going to get tails, right? So this is important to understand as well. And finally, you want to think of your trading as a business like you're a prop firm. So remember, I told you that prop firms' primary focus is to manage risk. So how they manage risk is that they hire all these traders. So all these traders are basically like your option trades. You have maybe one trade here, there. So maybe this this one of your option trade, this is a bearish trade, this is a bullish trade, this is a neutral trade. Basically, you have all these small little trades going on, but at the end of the day, you do not want any of these trades to wipe you out, right? Just like how these prop firms, they do not want any of these single traders, any of them to just close down their business, to wipe them out of all the money that they've made so far. Alright guys, so that's it for this video. I hope you found this video helpful. And by the way, if you haven't gotten your free copy of the Options Income Blueprint, then you can go ahead and get it at optionswithdavis.com/blueprint. So if you are wondering still what are the best option strategies that you can use to get a consistent income, then there's no need to look any further, because I've compiled the top 3 option strategies that can help you generate a consistent income every single month, and you can just use it to trade, just a few hours a day or even just a few hours a week. So again, if you want to download this, it's absolutely free of charge. Just head over to optionswithdavis.com/blueprint. Last but not least, I thank you for watching. I appreciate your time, and may the options favor you.